So we're hearing from credit unions all across the country about this new proposal from NCUA. Dennis, comments are due May 28th. Have you had a chance to look at the proposal?
Yeah, we have, and I would agree that we have concerns with components of it. Our credit union is very well capitalized, but I think my concern is more relative to the long-term implications of what it will do from the way we manage our business.
I think the current proposal is a bit scary because when you look at the actual numbers just for today, at the ratio levels, Woodstone Credit Union looks fine. But when you compare them, you actually see that our capital requirements have changed in the dollar numbers.
If the proposal is adopted, again, what we're going to have to take a look at is each and every business line that we do, and especially those where there are ratios built into the calculation. How close are we going to get, and what impact would that have on the business? Versus today, what we're really interested in is that are we financially sound with the one calculation for net worth, and are we serving our members? But now we're going to have to take a look at a number of other artificial, so to speak, calculations based on maybe situations that happened a few years ago and really should not apply to us and the expertise that we have at our credit union. And so should we really be managing to those numbers or managing to the needs of our members?
We have about 25% more net worth that's necessary for the minimum requirement for well capitalization on the PCA. Under the new system of risk-based capital, then we would have to raise an additional $48 million to have the same kind of cushion that we have under the PCA regime.
What it does is it has a couple things. One, it has a new version of an adequately capitalized requirement, which quite frankly is pretty similar to that current requirement. But the real zinger in this is that it has a new requirement also to be well capitalized based on risk factors. And that's what really calls for more capital in credit unions. And our analysis is it would increase for all credit unions nationwide who are covered by this by about $7 billion, the amount they need to be well capitalized.
To create the same kind of net worth cushion, $48 million, there's 2 or 3 ways we can actually do that. First, I can go to the membership and ask them to ante up $48 million. And that's going to come from lower dividends or higher rates on their loans. The second way is really to sort of ration services. So we have growth ambitions to serve members or folks who are in our field of membership. But with this regime of risk-based capital, we'll basically have to find a way to slow our growth down. The third way basically is to reposition our balance sheet. And by doing so, that leaves opportunity costs that we'll have to measure.
Credit unions came out of the financial crisis doing very well, continue to perform very well. You know, what's the big need for this change, this radical change in our risk-based capital requirements?
Well, I think the struggle for a lot of credit unions will be that a lot of us think risk-based capital would be a good alternative for credit unions, but the dilemma with this proposal is it just layers it in on top of the existing required capital positions. And I think it becomes more of a tool just to increase capital and not implement a true comprehensive capital reform package. So I think, you know, from my perspective, it would make a lot more sense if we were going at this in that manner, where we were going to reform the whole capital position, change the mandatory required capital number, and implemented a true risk-based capital program that really looked at balance sheets and established appropriate risk levels
and if
for
we
the
could
balance
do that
sheets.
in conjunction with a form of supplemental capital.
Absolutely.
If this is going to increase some kind of capital requirements, give credit unions access to additional forms of capital.
Yeah.
And if we are going to overhaul them, which I believe, again, we should, what we need to do is take a look at the leverage ratio and also the rest of the calculations. It's absolutely imperative that we take a look at this to make sure that credit unions have the ability to grow. And there have been issues in the past, such as with supplemental capital, where very good credit unions have had to stop their growth because of slow growth in capital.
So it's really a 3-part program here. Instead of just looking at the risk-based capital side, it's looking at ways, working with Congress to lower the leverage ratio, get supplemental capital, but also look at risk-based capital in the process.
Well, and I think the risk right now is it doesn't impact a lot of credit unions. I mean, we're all pretty well capitalized, and it's a little easy to be complacent about what the implications are. But again, I think the challenge is not so much today as what it will do to us going forward from a business perspective.
If this proposal is adopted, we will have to really calculate our decision making differently than we're doing today. Again, our capital is strong, but when it comes to growth of our business, which equates out to service to our members, it's going to hinder our ability in the meeting the needs of our members in our communities. And what really is a bit frustrating is that we are in markets and we must compete for our business. Every time that I have to make a decision that's limiting because of another regulation, I'm sending my members down the street to my competitors.
If we go forward and loan savings ratios come down, and if loan savings ratios go up,
Yeah.
and allowance for loan losses go down, a lot more credit unions will feel this biting.
Well, and if we get on a high growth scenario where we're growing our assets, it could be a real problem in terms of the ability of credit unions to be able to keep up with their capital levels in a high growth environment. So we want to be aware of that too.
So Dennis, as you know, as our chairman, CUNA is really leading the charge in terms of advocacy on this proposal to try to make sure that credit unions understand its ramifications for their operations. Could you talk a little bit about what you're planning to do in terms of further analysis, comment letter advocacy, but then also what do you think other credit unions ought to be doing?
Well, I think first of all, from an industry perspective, we need to be out there preparing our comments, because I think NCUA does listen to comments, and it's important that there be a large number of comments that are presented as alternatives to what's been proposed. We're going to look at it probably from a couple of different sides. One would be just looking at the initial proposed structure and comment on that, but then what I want to do with our team is look at some modeling in terms of what are the potential implications it will have on our future ability to do business.
Just expressing emotion, just expressing your dislike is not going to do any good. What NCUA needs to hear is the specific impact on your credit union and what you're trying to do for your members. The more you can make that particular, the more likely NCUA is to pay attention and to make the rule better.
We have some resources on our website that'll help all credit unions do that.
Yes.
We have a list of all credit unions behind the member protected portion of the website, where a credit union can look up what its capital ratio would be under the current rules, the proposed rules, and the Basel rule. We actually have a calculator that allows a credit union to play with changing their assets from one category to another to see what that would do to their ratios. As the point you make about individual comment letters need to be driven by the credit union's own analysis of its own situation.
All credit unions need to be going through the exercise. They need to be engaging with each other. They need to be accessing the great resources that CUNA has on its website in order to calculate the true impact of this proposal.
And we also have a tool, Bill, as you know, that will actually help credit unions write their letter. So it's not a good idea for credit unions to all send in the same letter or send in a form letter. So we can't really write a letter for anybody except for CUNA. We do have a mechanism that will allow the credit union to respond to some questions and put those responses in the body of its letter and then get it to NCUA and to its member of Congress. If credit unions want to send their letters to their members of Congress, we're all for that as well.
And I think that's our challenge, is to step into the opportunity and prepare thoughtful responses that will help guide this process. Hopefully we can rethink whether we need it at all, but certainly at least have a voice in modifying it into a form that's going to be more attuned to what credit union needs are, and look forward to what the potential future implications are.
Well, litigation is always a last resort because it's slow, it's expensive, and it's traumatic for a lot of people. But if we can get this rule improved enough, it won't be necessary.
If you think about all the issues that can affect credit unions, this is ground zero. This is the issue you draw a line in the sand on. This could have a major impact on how credit unions serve their members, how they're going to go about growing in their communities, and how they're going to survive at the institutions. So credit unions are just trying to decide, should I get off the fence and get involved in this conversation? This is the one.